Now we've got the pricing, but the problem is it takes too long. I mean, if you found a piece of property you drilled today and you found gold, you're not going to be up and running for 3 to 5 years anyway. So the supply is very inelastic. You're allowing more ounces to be bought for the same amount of dollars. If the price of gold or silver double, you're only able to buy half as many physical ounces. And that's what the problem is. The physical ounces don't exist to deliver. And be careful what you wish for, because like I said, we get to 70, 80, $100 silver, markets will break, and then you and I, we won't be doing interviews like this. We'll be worried about where the next meal is, going into your storage, go picking from your garden or whatever. The days of what do you want to eat tonight? Let's go to the corner store and pick it up. Those days are going to be over.
Market analyst Bill Holter warns that the next leg in precious metals may not bring celebration, but crisis. He explains that while prices for gold and silver could surge sharply, the supply side is highly inelastic. Even if discoveries are made today, it takes 3 to 5 years to bring production online. That means when prices double, the actual ounces available to buy are cut in half. The physical metal isn't there to meet demand. Holter cautions that if silver ever reaches $70, $80, or even $100, the financial system itself could fracture. At that point, markets wouldn't just be volatile. They'd break entirely. When that happens, survival takes precedence over speculation. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
I'll just go back to the failure to deliver of gold and silver. You can't print those. And, the suppression scheme has been on, I guess, really since 1996, since Robert Rubin's strong dollar policy. But when you suppress the price of something, what you're doing is you're creating more and more and more demand, and you're inhibiting supply, because there are mining companies that would have drilled. There's mining companies, that would have grown from exploration stage that didn't, because the pricing was not there. Now we've got the pricing, but the problem is it takes too long. I mean, if you found a piece of property you drilled today and you found gold, you're not going to be up and running for 3 to 5 years anyway. So the supply is very inelastic, and suppressing the price, you're allowing more ounces to be bought for the same amount of dollars. If the price of gold or silver double, you're only able to buy half as many physical ounces. And that's what the problem is. The physical ounces don't exist to deliver. And we're going to find out. I believe it's going to be, there's going to be a big problem in the December delivery. We'll see. That's opinion on my part. I try to do nothing but facts and logic, but opinions got to come in. And I believe that December is going to be the problem. Just look at this month, the amount of gold contracts that were standing for delivery at the very first day. That number is now double later in the month. And if you go back 3, 4, 5 years ago, it used to be you'd start with 100 contracts, and by the time delivery was done, you'd only have maybe 20 or 30 contracts still standing for delivery. Everyone else accepted fiat settlement payment in cash. That's not the case now. What you've got every single month is you start with that same 100, and by the end of the month, there might be 200 or 300 standing for delivery. So they're stepping up, they're buying the current month, and they're saying, I want deliveries. And, this is October's another month as an example. I mean, I think there's only 1 month this past year that the contracts standing for delivery were actually less than first notice day. But month after month after month, people are stepping up, buying the current contract and saying, I want it delivered. And December, just because it is a big delivery month, it's one of the biggest. That one stands out in my mind as a very real potential of this thing breaking. I mean, you had buyers all over the world having metal delivered out, and there were rumors that China and COMEX, they've sent metal over there to try to help supply for the delivery. Just understand that silver got more overbought on this run than any time. I think we equaled where silver got to on an RSI on the overbought with the 1980 Hunt Brothers episode. So to see the pullback, that's no surprise at all. And we should have had a pullback prior to even getting to 50. They ran it to 50, ran it up to 54, 50, or thereabouts. It ran, 10% through the 50 number, pulled back. Gold now is back over 4,000. Silver's at 48 and change, sniffing at 50 again. Once these things get their legs under them again, you're going to see another run. But they were due a correction. They have worked off some of the overbought. They're certainly overbought on the weeklies and monthlies, but the dailies, the overbought has been relieved somewhat, and let's see what happens. Again, I had tons of emails, people saying, "Oh my God, what's going on? The market's down. How come silver's down? How come gold's down?" You have to expect corrections. I mean, even in Weimar Germany, when that was ramping up, you had periods of time where gold and silver were down early in the 1917, 1918. By the time 22, 23 came around, it was straight up, but you were looking at a mass exodus out of a currency and into gold and into dollars at the time, or dollars and pounds at the time. So we were due a correction. We got a correction. And when people would email me, "What's going on? Why is silver down?" I got to the point I was responding, doesn't really matter. Who cares? And be careful what you wish for, because, like I said, we get to 70, 80, $100 silver, markets will break. And then you and we won't be doing interviews like this. We'll be worried about, where the next meal is, going into your store, picking from your garden or whatever. The days of, what do you want to eat tonight? Let's go to the corner store and pick it up. Those days are going to be over.
According to Bill Holter, the cracks beneath the precious metals market are deepening. He points out that the long-standing price suppression, which dates back to the 1990s, has only fueled greater demand while stifling new supply. Mines that would have produced gold and silver never came online because prices were held artificially low. Now, even with prices rising, physical supply remains dangerously tight. Delivery requests on COMEX are doubling instead of shrinking, on a signal that more investors want real metal, not paper promises. Holter warns that December's delivery month could expose a breaking point in the system, with physical shortages becoming undeniable. When that happens, he says, we move from market talk to survival reality. Let's get into the interview.
I don't know in dollar terms. I suspect, you'll see a pullback. Okay, I've just pulled the story up. Yeah, they did cut rates, and they're going to end their balance sheet runoff in December. So, I mean, this is they're pumping more money into the system. As far as your question goes, the rest of the year, that's you're looking at 2.5 months, and I suspect things are going to get bad, like really quickly at some point in time. It could be, and it very well could be December, because you've got a big delivery month for both silver and gold off of COMEX. If either of those fail to deliver, it's game over, and we'll be within Mad Max world. The beginnings of it are 72 hours after that happens, because you're talking about the human stomach. How many people have food stored up? Not a big percentage of the population, and I would say a bigger percentage of the population has nothing stored up.
Yeah,
juicing the markets now, I think, is a big mistake, because I'll ask you a question. What happens in a month or 2 months or 3 or 4 or 5 months, and all of a sudden the economy's starting to sputter and the markets have turned down, the markets are getting smacked? What's the Fed going to do? Cut more, just keep cutting? We're going to go back to 0% rates, or are they going to try to, like they did before, try to foist negative rates, which make no sense whatsoever? There's no logic to that. But cutting rates with markets at all-time highs is a huge mistake, and it will create the conditions for really high inflation. Right, and then the question is, if those contracts can't deliver, what is the value of a contract that cannot perform? The answer is zero. This goes back to what my late partner Jim Sinclair used to say. He would ask that question, what's the value of a contract that can't deliver? And he surmised that, you very possibly could see COMEX at $10 per ounce offered, no buyers, and the cash market at 50,000 ounce bid and no sellers. And that's an illustration right there of a contract that cannot perform. It'll go to, the paper will go to zero, and the metal itself will become unobtainable.
Bill Holter warns that the coming months could expose the fatal weakness at the heart of the financial system, the failure to deliver real metal. With the Fed cutting rates and halting balance sheet runoff, he argues that liquidity injections are creating the illusion of strength, while quietly accelerating inflation and systemic decay. December looms large not just as a big delivery month for gold and silver, but as a potential tipping point. If COMEX or LBMA fails to deliver, the paper price will collapse to nothing, while real metal becomes priceless and unobtainable. In Holter's words, that would mark the end of confidence and the beginning of survival economics. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.